Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to cover velocity banking and talk about the scenario of using multiple credit cards, which is actually a little bit more advanced in my opinion. If you've never heard of velocity banking, never watched the video, go ahead and click the link down to below to Velocity Banking 101. They'll give you a firm foundation of what the concept of velocity banking is about, and then come back here, and then you'll be able to see what happens when you have multiple credit cards and are trying to do velocity banking. Okay, so just a few notes. When you have multiple credit cards and no access to a line of credit, like a personal business or HELOC, that's actually not an ideal scenario. I think sometimes people watch velocity banking videos and then they get, they hear, oh, loans bad, credit lines or credit cards good, and then um, for whatever reason think, oh, I should use all of them. And the idea is that you're only trying to use one of them if you can, because we're trying to prevent something called segregation of income. If you have too many debts, whether it's credit cards, credit lines, loans, think about if you had like 10 of those loans, right? What would happen? Your money would be split up into 10 different places. And the whole idea with velocity banking is you're going to just park it into one place so that you're using your cash flow to eliminate the debt. Now, another reason why it's not an ideal scenario is that when you're using credit cards, there are limitations. So first limitation is you can't pay a credit card using one credit card using another credit card. That's the first limitation, right? So unless you have balance transfer, the ability to do a balance transfer check, or maybe some sort of possibly cash advance, which I would really do, um, you can't really pay off a credit card using another credit card. Another thing too is you can't pay off a loan using another credit card unless you're using an intermediate service like Plastique or again some sort of cash advance, right? And so it's easier to work off a line of credit. In fact, if I pull out $5 today from a line of credit and pay the exact line of credit, same amount into the line of credit that I pulled it from, I can do it no problems. Bank doesn't care, right? So it's not that the bank cares, the bank cares about based on what product you're using, and that's the limitation of using a credit card. So in this scenario, when we're using credit cards, we're gonna have to go one by one just because of the limitation of that the line which doesn't exist in line of credit. So line of credit, you could just group all the debt, free up your cash flow, and you're good. You see that in Velocity Banking 101. Here it's going to be a little bit different. So let's just go to our spreadsheet. First things first, when we do velocity banking, we have to do two things. First, get our expenses budget, do expense breakdown, and then we have to just select our main operating account for velocity banking, and then just do what we've done before, which is apply our paycheck, take our expenses, rinse and repeat over and over again. Okay, so now we have our budget here. So once we have our paycheck, expenses, checking savings, where we're parking our money after all expenses are done. No, first, the most important thing is making sure that we have our expense breakdown. So every single debt that we have must be its own line item, whether it's credit card, loan, line of credit, because every debt that we have eats up into our cash flow, and the whole goal is to eliminate the debt to free our cash flow. Other things that aren't debts like rent and other things, food, gas, insurance, we can actually combine into one line item, but every debt that we have must be its own single line item and cannot be combined. Okay, second thing is we need our main operating account to work off of. So I see 3 credit cards here. We don't have any lines of credit. I'm going to work off of this one because it has the highest limit and the highest payment. Um, we'll just assume that the interest rates are uniform across all 3 cards. I know that's not realistic, but let's just make the math easy for all of us. So what we're going to do is we're going to use this credit card here. So that's our $15,000 limit. And we're going to use this balance, start off with this balance, which is $10,000. So unlike lines of credit where you can just combine things and do debt transfer, we don't have that ability with the credit card. So we're going to have to slightly adjust our behavior. So when we use any account as our main operating account, this essentially becomes 0 because when we pretty much put our entire paycheck into that line of credit or credit card, that minimum monthly payment doesn't really even matter. It's not really an expense. It's just the bank saying, hey, you just have to pay this much in order to keep using the account, And since we're dumping our entire paycheck, who cares, right? Now we're gonna have to do a few adjustments. So instead of directly paying from the credit card to a credit card, because we can't do that, we're gonna park this amount into our checking and savings so we can pay off those credit cards or the minimum amount. So as you can see here, instead of depositing 5,000, we're only going to deposit 4,700, and we're going to have the same rent and other expenses. So this will be $2,000 now, right? And so our cash flow that we're going to use to decrease our line of credit balance is actually just this minus this, right? So whatever goes in a line of credit minus whatever is taken out of the line of credit, that's essentially going to be our cash flow. Okay, so the way that we calculate that is C2 minus C3. Okay, so 2,700. All right, cool. So now what we do is just we do what we've always been doing. We apply this to here. We apply our expenses, we take them out of here, and then after each month, the balance would go down by 2,700, right? Okay, so let's just do the math, make it easy. So equals H2 minus 2,700. And then we just rinse, repeat. So this will be months 0, 1, 2, 3. So after about 3 months, approximately, we're going to pay this thing off, and then we're going to go from one account to another. So once this is 0, we're just pretty much not going to use it anymore. Now, I'm doing an estimation of the math. I know that I'm not going into nuances. Some nuances you might kind of figure is that, hey, you know, if you're paying $150 while doing this, the balance of the credit card is going to decrease, and so is the payment. I get that, but we're going to we're trying to understand the concept here and not do the very detailed math. But let's just go ahead and estimate the interest. So the way that we do that is essentially we get the interest rate, multiply it by the previous month's balance, and then you divide by 12. All right. Oh, what did I do? Did I do something wrong? No, yeah, I totally did something wrong. So previous month's balance is actually H2. And then we do it like that. And then we get sum, just simply click this auto sum right here. It'll sum it up. And as you can see, we paid $495 to pay off this debt in about 3 months. Pretty cool, right? So now we just put that here, 495.8. All right. So now, again, rinse and repeat, rinse and repeat. So now what we do is that with the credit cards, now if we had a line of credit, we just use that line of credit as our main account. But since we don't have lines of credit, what we're going to do is we're going to switch the velocity banking operating account once the first credit card is paid off. So it's going to be a little bit different. So now what happens is that since we're going to use, let's say, credit card 2 as our main operating account, the credit limit here will be $10,000. The balance will be $5,000. Again, not realistic, because when we make the credit card payments, you know, for 2 or 3 months, the credit balance will go down and the payment amount will go down slightly. But work with me here. Okay. So now what happens is that when we do that, this becomes 0 because whatever is our main velocity banking account, the expense really doesn't factor into our cash flow anymore. So this will be $150 in savings, and then 4,850, right? So the only thing that we have to pay out of our checking savings account is credit card number 3. And we just rinse and repeat over and over again. So this will actually probably be easier because the balance is lower. So H2 minus our cash flow, 2,850. And then this will go to 0. So we paid this off in about 2 months, right? Wow, that was really easy. All right, cool. So now we just calculate the interest again. So H2, I'm sorry, 0.25 times H2 divided by 12, right? And we paid, sum this up, 149. Now you might, you know, I don't think I'm not sure if I mentioned this, but you might say, why do you divide by 12? Because interest rates are quoted annually, and you want to just get the monthly interest, and it's actually not correct technically because they do an average daily balance calculation, but this is good enough. We're not going to go too detailed. Well, oh, the balance for the average daily was this, blah, blah, blah. Just do monthly. You'll get a number that's close to what you're looking for. All right, so now we have $149. So let's just do $149 of interest. So we paid that off. So you'll notice what's different from this scenario is that we were able to immediately release cash flow if we had a regular line of credit, but because of limitations of the credit cards, we can't do that. So we have to just kind of go one by one. Okay, so now we just essentially repeat the same thing over and over again, right? We'll just assume that the limits are pretty much kind of the same, but not really. So now this is what we're gonna do. This will be 0. We're gonna have that 0 here, and then 5000, right? And now we have $3,000 of cash flow, right? So if we're using credit card number 3 as our main velocity banking account, this is going to be $6,000 credit limit, $5,000 balance, and now we're just going to do this. Subtract $3,000, right? And so now all that happens is that, yes, we pay it off in the same time, but our interest, 145.8. So we saw that, right? So now, in order to figure out how much interest that we paid, all we have to do is just sum this up, and we paid, oh no, it's not summing up correctly, so let me just do it manually. So sum D7 to D9. And so basically we paid off these 3 credit cards of $20,000, and we paid about $790 in interest, right? So we paid it off in record time. So you might say, like, who does that? Pretty much nobody. So it's not the most ideal situation because we're working off of multiple lines of credit, but we can still make it work, right? So we can definitely still make it work. It's not as flexible. You don't free as much cash flow because you can't move all the debt into one line of credit, but it still works, right? The idea is still there. You're going to work off of mainly one line of credit. The only thing that we had to do differently is we're just going to not park our entire line of paycheck in there, just to reserve our minimum payment for the 2 other credit cards, and then we tackle one line of credit on at a time. Now, I know that some of the math here was oversimplified, but I want to make sure that we get the idea of what to do with multiple credit cards, rather than going into the, being here all day and doing the minute calculations where maybe you find out you pay, an extra $10 or $20 more, right? All right. So this is Korean Atlanta Mentorship. If you're interested in joining our group, go ahead and click the Google form link below, or you can go ahead and click the About Us section in the YouTube channel. Go there, and then send us an email, and we'll reply back and see if you're a good fit for our group. All right. Have a great day, everybody, and we will speak next time.